We have microfinance banks and fintech. Most recently, we have equity options, angel investments, crowdfunding, venture capitalists, and then business credits. I think I would like to make this this session a bit interactive. I would like to know if anyone has ever accessed any financing option for their business in the past. If you have, you can just send a yes on the chat. Do we have anyone who has accessed finance for their businesses in the past?
Yes, we
Yes,
have
grants and loan.
Oluwa Femi here.
Beautiful. Microfinance bank, beautiful. So it looks to me like some of us have actually accessed finance for our businesses before. So let's dive in and then look at more details regarding these financing options we have for SMEs. Okay, let's move to the next slides. So first of all, we'll be looking at bank loans. Bank loans are mostly issued by commercial banks, Islamic banks, and also microfinance banks. Some of the characteristics of bank loans are they are usually very, very stringent rules. They usually have a list of requirements because they are regulated by the central bank and other regulatory agencies. We all know how banks mostly get their funds. They get their funds from shareholders, and shareholders invest in these businesses because they want returns on those investments. As such, the banks would not just give out monies to businesses which they know they might not be able to recover. That is why when you go to a bank to access loans, you usually have them give you a list of requirements such as guarantors. You're bringing your bank statements so they can see your transaction history. They want to be sure that you're actually qualified to be able to access that loan. One of the issues we also have with bank loans is there are usually regulatory bottlenecks. We have huge compliance levels. So you would have to be very, very compliant to be able to access a bank loan. We also have various risks associated with bank loans. If you take a collateralized loan, for instance, which might require you giving up one of your assets to be able to access a bank loan, you stand a risk of also losing that asset if you're not able to pay timely. Banks would usually also have a collateral requirement in some instances. So this makes assessing bank loans seem a bit difficult, even though it comes with its benefits, depending on which of the banks you're accessing a loan from. Loans can usually be obtained from commercial banks. Some of the examples we have are Trust Bank Limited, Bank Windec, Eswatini Bank, Zanaco. We have Standard Bank, which is present in a lot of African countries. We also have Stanbic IBTC in Nigeria, which is regulated, which is a member of the Standard Bank Group. There are also a lot of Nigerian banks, such as Access, UBA, which are resident in other West African countries and also in other parts of the world as well. For Islamic banks, we have Taj Bank and Jaiz Bank. These banks mostly give loans. Their requirements might not be as stringent as those of the commercial banks, and they have something in Islamic finance called riba, which is interest. So the Islamic banks give loans without interest, known as riba. They have other ways of recovering their monies when they give loans to you. We also have microfinance banks such as Money Point, Carbon, Rent Money, which are popular in Nigeria. With these banks, you mostly do not have to submit any physical documents. You're able to do your applications online, submit all your documentation online, you get the approval online, and you have the funds disbursed to your business account. We'll look at the next funding option, which is equity and venture capital. Now, what is equity? When a business brings equity on board, it means they are giving a stake of their business to either an individual or organization. In equity or in shareholding, we usually have individual shareholders and institutional shareholders. Institutional shareholders refer to organizations which invest their funds in other businesses or other organizations for them to be able to make returns and also give to their own shareholders. Now, when you bring equity into your business, it could lead to a dilution of shareholdings and control. It means that if, for instance, my business is Ngozi Nigeria Limited, and originally I had 700,000 shares out of the 1 million shares in my business, and I decide to bring a shareholder on board, that shareholder might end up taking maybe another 100,000 or 200,000 of my shares, meaning I would have less shareholdings, and it could also lead to a dilution of control because that shareholder will also want to exercise some level of control over that business. With equity, there might also be a lack of goal congruence. Now, this means ensuring that the goals of the business owner also align with all the other stakeholders or shareholders in the business. It might become more difficult for you to agree with the other shareholders in the business compared to when you are the sole decision maker or when you're in control of that business and you make majority of the decisions. We also have risk and business losses, which are shared by all shareholders in the business. It means when the business is profitable, you all share the profits. When the business is also making losses, you share the losses and also the risks that come with doing that business, such as business risk, reputational risk, and everything that comes with that business. With equity financing, there's usually a requirement to have a high rate of return, and this makes it very, very expensive. Then there's also a no repayment obligation. When someone invests in your business or has a stake in your business, it's not the same thing as taking a loan. When you take a loan from a financial institution, we all know that in Nigeria, most times, most banks do not even give moratorium. So you start paying that bank loan from possibly the next month or the next week if it's a weekly repayment. As such, equity investments would usually not have a repayment option compared to when you have taken a loan from a financial institution. The next financing option we'll be looking at is venture capital. This requires investors to also take a stake. It requires investors putting in a stake to finance a business. It's most common with startups, and it usually has a lot of due diligence requirements. For instance, for someone who wants to invest, a venture capitalist that wants to invest in your business, they'll do a lot of risk analysis. They'll want to be sure that the business is compliant with the rules and regulations of that country. You're paying your taxes. You're not taking unnecessary risk that would make that venture to be unprofitable. Then the venture capitalist would also want to be involved in the running of the affairs of the business. So it's no longer business as usual, whereby you're the only one running the affairs of the business, taking decisions for the business, deciding how much your operational expenses should be, or setting your budget. The venture capitalist would be involved in the management of that business. Now, with venture capitalists, we would usually have VCs or venture capitalists exiting after a certain period of time. Next slide, please. Then we also have angel investors. Who are angel investors? They are private investors who usually invest in small or startup businesses for a return. For instance, I might have a friend who I know is a high wealthy. The person likely has a lot of funds. Say, for instance, I have a friend that is maybe not as wealthy as Dangote or Tedola, but has like a huge amount of money, and I'm looking to start up a business. I can approach this person and say, oh, I have a business idea. I would like to share a proposal with you. And if it works with you and you invest in my business, I'll give you this rate of return. This works. I have actually done this in the past and it worked for me. So instead of going through financial institutions or going through the banks and then documents and signing documents, I approach an individual and say, oh, I have a profitable or viable business idea. We analyze it together. We have an agreement, and then you get an amount of return after a certain period. It could be a year, it could be 6 months, it could be 3 months, or whatever it is. Now, with this source of funding, the investment terms are usually negotiable because you're able to agree with this person, and it's not as stringent as what you would have with commercial banks. We also have another form of financing which businesses can have, which is called, so it means I, as a business, I can approach another business or a vendor and mention to them that, oh, I am interested in a certain product or a certain service, but I am unable to pay cash immediately and would like to pay in 30 days, 60 days, 90 days, whatever the agreement is. If you look at the images on the right-hand side, we have a supermarket on the right-hand side. Most supermarkets actually have this model running for their businesses. So when you've built a business over time and people know your business, it's easy to have this kind of partnerships and have agreements with other businesses. And it comes at a lower cost of funding because you are not paying when you get money from the angel investors or when you get money from the commercial banks or the microfinance banks. They organize it without an interest on it. You might only pay additional funds where you start to default on the agreed payment terms. For you to access this kind of credits, you usually have to agree with that business on the amount of credits you would like, and this has to be approved by the supplier. The number of days also have to be indicated, whether it's 30 days, 60 days, or 90 days. And you also have to prove as a business that you are credit worthy for you to be able to access this line of finance. Like I mentioned earlier, supermarkets usually have this model. And then there's another model which businesses can also access, especially if you're in the retail business. And it's called the sales or return model, whereby you partner with businesses, they stock up your store, and then if you're able to sell, you remit as you sell. If you're able to sell those products after a certain period of time, then you return those products to the vendors. But again, those products must be in a good state, must not have expired, and you must also have made a lot of efforts to be able to market these products. Some of the benefits of supplier credits are it boosts cash flow and improves working capital, and it's also dependent on trust and business reputation. I would like to use an example I currently have. Late last year, I started using Bolt to do deliveries for my business because I noticed that my bike was always having issues and I was always having issues with the delivery person. Now, what did I do? Because I was using Bolt for my deliveries over time, my deliveries increased. And in January this year, Bolt called me up and offered to give me a credit line of a certain amount, whereby I only pay in 30 to 40 days. Now, what does this do? It means that my customers would order goods for me, pay me cash immediately for me to be able to deliver their items. But again, I don't get to pay both this money until after 30 days, meaning I can actually choose to invest those funds I have gotten from my customers, put it to good use before I pay both in a number of days. So these are things that you can do over time to be able to grow your finances for your business. Any questions so far, or should we wait till the end of the presentation?
I think we should wait until after presentation.
Okay, that's fine then. Okay, so next we'll look at the examples of funding options we have in Africa. So we have the Tony Elumelu Foundation Entrepreneurship Program, which really has a $5,000 seed capital and mentorship for African entrepreneurs. I know that this usually happens in Q1 of every year. We also have the MasterCard Foundation. We have the African Development Bank. They have a lot of programs which they use to support support youths and also women entrepreneurs. We have the World Bank or International Finance Corporation SME support programs. We have the UNDP. We have the UN agencies. And we also have grants which are given to businesses and also business development programs. We have GIZ, which is a German development agency. They support a lot of SMEs in Nigeria and around the world. We have business grants, advisory, digital skills training for SMEs. I know that in the last, I think 1 week or 2 weeks, I saw MTN advertising some trainings, free trainings for entrepreneurs. And I know of other organizations that have done this in the past. Now, training comes at a fee. If you ask someone to pay, for instance, for a data analytics program or for a Microsoft Excel training, it will usually come at a cost. But there are lots of organizations offering these trainings for free. So I look at this as also a funding option which businesses are getting. If organizations such as MTN were not sponsoring these programs, would have your business have to put in a budget on a yearly basis or quarterly basis for training of its employees, for them to be able to attain certain skills and also grow the business. So I would consider digital skills trainings and the many other trainings offered by various institutions as a funding option as well. Okay, next we look at the key challenges we face when we're trying to access funding for SMEs or for our businesses. We have limited access to capital. We all know that we have a lot of SMEs in Nigeria, and it's difficult to actually give everyone what they would like. I believe that's why in economics we were taught opportunity costs many years ago, scale of preference and all of those things. We all know that the resources would never be enough for everyone. We also have high interest rates. From my practical experience, with the commercial banks, it's more stringent to access funding. But most times, the funding would usually come at a lower cost. Why? Because the banks usually do way more due diligence, check your financial statements, check your business records, check your physical location to be sure that your business exists, and therefore offer lower interest rates. With the microfinance banks, you might stay in the comfort of your home or your office and be able to access a loan. But then at what interest rates does it come at? Most microfinance banks will charge you interest rates of, say, 5% or even more. And then what are the repayment times? The repayment times are usually so short, sometimes as short as 3 months or even 6 months, meaning it stresses the business cash flow and does not make it very easy for the business to be able to access loans. So I've covered high interest rates and short repayment periods. We also have lack of education or knowledge about financing options. How many individuals that run business genuinely know about the many financing options that businesses have? Many people do not know about financing options, and this impacts negatively on the ability of SMEs or businesses to access financing. We also have improper documentation. A business that does not keep records would find it difficult to access funding. We have low credit scores. In Nigeria, in the last few years, I'm aware that there's been a credit bureau, and there are certain organizations registered with that credit bureau to be able to document credit information about businesses and about individuals. Now, this information, loans or facilities you've taken over a period of time, how well you repaid those loans, and this impacts your credit score. If you have a high credit score, the chances of you accessing a loan would usually be high. But if you have a low credit score, the chances of you accessing a loan facility from a financial institution would also be very, very low. We also have collateral requirements. With loans that require collateral, most times their interest rates are usually lower because the bank knows that they already have something that they can hold on to in case of a default. Not everyone is able to provide a collateral for loans. But in recent times, I think I've seen a billboard for two organizations, AutoCheck and some other organization, whereby if you have a vehicle, you can actually take the vehicle to them and then it acts as a collateral for you to be able to access a loan. But how many SMEs actually have a tangible collateral that they can give to a financial institution to be able to access a loan? We also have guarantor requests. Most times it's difficult to find credible individuals who can act as guarantors for businesses. And also reputational risk. Most people are afraid to act as guarantors for businesses because of the chances of default by the individuals which they have acted as guarantors for. We also have regulatory bottlenecks from the various regulatory authorities in our various countries. Next, we'll be looking at how we can prepare for funding for our businesses. The first step I would always advise every organization is register your business in your country according to the regulatory requirements. No bank wants to give a loan to a business that is not duly registered. So you must register your businesses to be able to access proper funding from financial institutions, from donor agencies, from the World Bank, from the UN agencies. They all want to be sure that you're doing your business in the compliant way by first of all being registered. Then the next step is to keep organized and accurate business records. This includes things such as your financial statements, ensuring you're separating your personal finances from your business expenses, analyzing your records on a monthly basis to know where you actually have cash needs to be able to take proper decisions. Then preparing and documenting your business plan. If you have a documented business plan, it shows where your business likely wants to be over the next few years, and it makes decision making for the financial institutions much easier. Then it helps when you have a clear strategy. You have an annual budget or a quarterly budget, which you review against your actual figures from time to time. If you also have a marketing plan and you have strong branding, this helps to ensure that you have proper funding. For instance, if a business applies for a loan or a grant and they tell me, oh, the name of my business is XYZ Limited, but I don't have, say, a website, I'm not registered on Google, I'm not on Instagram, I don't have any visibility whatsoever, I'll find it difficult to trust such a business and be able to give it resources, give it a loan or give it a grant and trust that it will put it to good use. You've been able to brand your business, you have a proper logo, you've been able to do marketing either on Google, you have ads, you run Google ads on Facebook, you run ads on Facebook, on Instagram, or you do some form of marketing. I would find it easy to be able to make a decision and finance or support such a business. Then do you keep up with trends in your industry? If you're selling foodstuff, for instance, are you aware what's happening in your industry? Do you know what the prices are currently saying? Do you know if there have been innovations in that industry? You must be knowledgeable in that industry that you have chosen to operate in. Then you should have documented organizational policies for your finance department, for human resources. You should have policies for sales, for marketing, and for everything that you do in your business. You can also choose to introduce sustainability programs. When I say sustainability programs, there are a lot of things that are covered. We all know what has been happening with global warming. We hear people talking about, going green, printing less, recycling bags. When you put these things into your business, you see that even investors will be more interested by, saving its recycling paper, because if you choose to use paper bags over plastic bags, which end up in the sea and cause harm to aquatic life, right? you'd be able to access funding much more easily and attract attention from even the international organizations. Now, these are the various ways that we can prepare our organizations, no matter how small, for funding from banks or from other organizations. Next steps we should take when we want to access funding.
Thank you, Madam Nongo. We are not certain if this is still a network issue. We also would like to welcome members as they've joined into this platform of ICBC Launch and Learn June series. I would like to welcome our participants. We have taken note of a question from Mr. Uthman Zakaria, and we want to encourage questions to be sent to the chat forum. We'll take your questions, and we believe Madam Nongo will attend to your questions in due time. Madam Nongo, are you here again?
Yes, please, I'm here. Please let me know if you can hear me.
Okay. Yes, we can hear you. Thank you.
Okay, so would you want me to take the question, or can I go ahead and take the question afterwards?
Your schedule, please, as preferred. Thank you.
Okay, so let me take that question quickly, just so that we don't miss it. So a credit score is a score that is usually assigned to an individual, and there are certain factors that will be considered in giving you a credit score. For instance, have you accessed a loan before? Have you repaid that loan on time? How many loans do you have running? Are you in default? Have you taken loans that have exceeded your repayment ability? These are factors that would usually be taken into consideration in giving an individual a credit score. If you haven't taken a loan before, you most likely have like a low credit score. Most people are afraid to take loans, but without taking a loan, you would most likely not have a credit score or a good credit score. I hope that clarifies it somewhat, Mr. Othman.
Thank you, Madam Nongo. Can I ask a question from that credit score, is it a Nigerian thing or a diaspora thing? Is it an American thing? Do we have this status, this kind of statistics here in Nigeria? Thank you.
Yes, we do. Yes, we do. It's a global thing. If you go to other parts of the world, you hear people talk about credit cards, but we have credit cards even in Nigeria. We have credit cards in Nigeria. So if you have a credit card, it gives you a credit score. So this is handled in Nigeria by the Credit Bureau, which is regulated by the Central Bank of Nigeria. And as I know, there are, I think, two credit bureaus in Nigeria. I can't remember their names right now, but we have two credit bureaus in Nigeria. So when you take a loan from a financial institution as it is now, there's a central database where that loan is booked. And on a monthly basis, your financial institution goes there to go and update your details to see if you have paid that loan on time or not. If you've also defaulted, that loan is also shown. So when you want to take a loan with a financial institution, for instance, the banks would go and check your credit score using your BVN. Now, with your BVN, all your bank accounts are linked together. So once your BVN is put in, all the loans you have taken from all the financial institutions, whatever credit cards you have, they all show up in that portal. And your performance shows this also, based on that performance, your credit score is built. I don't know if that clarifies it.
Thank you, doctor. Thank you.
I'm not a doctor, though.
We may get there.
Hello. Yes, I hope so. I hope so. I think that's a source of inspiration for me, actually. When you said that, I just kept saying, this is probably an opportunity for me to make a move. Okay, so would move to the next slide, the funding process. Now, when you want to access funding for your business, what are the steps you need to take? First of all, you need to identify your funding needs. What do you need funds for? A lot of businesses say, a lot of individuals or businesses would say, oh, I need funding, I need funding, I need funding. But have you actually analyzed your business to see what you need funding for? Do you need funding for marketing? Do you want to do more ads? Do you need funding for inventory items in your store? Do you need it to be able to train your staff better? What do you actually need funding for? You first of all need to identify the requirements that your business needs to be able to know what amount of funding do you need. For instance, somebody will say, oh, my business is suffering. No, if only I had funds, I would have done this, I would have done this. How much funds do you actually need? Have you checked that, maybe your customer base has increased by 500 customers and you're not able to meet demand and you need, say, 10 million naira? Have you been able to assess that? If you've not assessed that, then you haven't even identified the funding need your business requires. Next, you look at the options. We've gone through a number of options that a business would usually go through when they need to access funding for their businesses. We have options such as the traditional bank loans. We have savings for those who probably have jobs and are able to make savings and then start up their businesses on the side. We have grants for startups and a whole lot. You need to explore the various funding sources to know which would actually be able to meet your needs. If you're a business that has just started up with practically no business records, you've not made any sale, you've not proven to the financial institutions that there's something possibly viable with your business, how then do you approach a bank to give you a loan? If you've not sold anything, if you've not recorded any transaction, I don't think any bank would give you a loan. So you need to look at the various options and know which would work for you. If you're starting a small business, say from your home, you can choose to approach your friends. You can choose to approach your family members and say, oh, I have a business idea, a viable business idea. And of course, if they believe in you, they might be able to support you with some funding. Next, you need to prepare your documentation. Gather all necessary information to support your funding application. If you're applying for a bank loan, the first requirement the banks will usually ask you for, like I mentioned earlier, would be your BVN, because they want to check your credit history to see what's going on with you in terms of your credit score and what you've been able to do with credit in the past. The banks will also ask for your bank statements to see how well you've had transactions going in. Now, for some individuals, sometimes they just put in fictitious amounts, possibly put in funds to go into the business and come out. I would like to say that does not help your business in any way, because you might end up accessing funds that you genuinely do not need and not put it to the best use. So first of all, you need to put together, if it's your bank statements, your company registration documents, tax compliance documents, audited financial statements. If you need to get guarantors, if you need to get post-dated checks, you need to put together all these documents. If you need to put together a budget, a cash flow projection showing where you think your business is going to be in terms of cash in the next few months, or the impact that loan would have on your business in the next few months, then you need to put together all of this documentation to be able to support your funding requests. Next, you submit your application. If it's a bank loan, if it's a grant, whatever source of finance you're looking to access, you submit the relevant documentation for you to be able to, for the organization to be able to review and also take a decision as to whether they're going to approve that request or reject it. Next, we look at solutions, various solutions, SMEs, various solutions for SME funding. As an SME, if you're just a startup, like I said, you most likely would not be able to access a bank loan. What other options would you look at? You need to look at various options of funding. That's why we have like a tall list of funding options for various businesses. So as a business or as an SME, you need to explore the various funding options that your business has. You also need to be able to build a credit history to improve credit score. Do not run away from taking loans if your business genuinely needs a loan. You just never know when you might need a big loan. If you've not taken a 100,000 naira loan and showing that you're able to pay back that loan, the day you need 100 million, no financial institution would give it to you. So it helps most times to take loans and increase the values of those loans over a period of time and show your capability of paying those loans to be able to build credibility for yourself and for your business. Sensitization on financing options for businesses. When you want to take get funding for your business, consult an expert to be able to discuss with you and look at your current business needs so that they can align or let you know the best funding option that aligns with your business goals. For instance, if you're a business that doesn't have regular cash flow, would it make sense for you to take a bank loan where you have to start repaying immediately? If you're an if you're a company or a business that imports goods and you know that it's going to take you 3 months to bring those goods into the country, does it make sense for you to take a loan and start paying back that loan immediately when you haven't even received the goods and you've started selling them? Would you be able to start paying that loan immediately? I would advise that if you need to access funding at any point in time, you consult a finance expert or a business expert or your financial institution to be able to look at the best option that works for your business. Business management trainings. As a business owner or a business, you need to attend as many trainings as possible to be able to improve your business competence so that you can know the best funding option that works for your business. I already talked about utilizing consultants or experts. With this, I believe that as an SME, we should be able to get better funding for our businesses. And then now we're on the last slide. As a business, when do you actually seek finance for your business? Sometimes we need to acquire assets. In Nigeria currently, we have issues with electricity, and the rave recently has been for most people to go with solar financing because we've had increased electricity bills. If you need to purchase an inverter, for instance, that would be an asset in finance terms. And this can be gotten by lease, or you can pay a certain percentage and pay the balance over a certain period of time. This is where trade financing. The Islamic banks, for instance, I know they do something called trade finance. For instance, you want to buy goods, you submit your invoice to them, and then they pay for those goods, and then you repay over a certain period of time. Other ways of inventory financing would be the sale or return option I spoke about that most retail businesses or supermarkets also have. Then we have short-term capital needs or working capital. When you have short-term capital needs, such as cash for a short while or cash to either buy inventory, pay certain expenses that you just need to sort out immediately. You can also access finance either through bank overdrafts from your financial institution or some short-term loans that you can pay in perhaps 30 to 90 days. You can also seek business finance when you have increasing customer demands. If at the time you started your business, you were selling perhaps a crate of egg a day, and currently the demand has risen to 30 crates of eggs a day, you'd realize that if you don't have the capital to be able to get 30 crates of eggs to satisfy your customers or beyond 30 eggs, you'll be losing your market share to other businesses which have the capability of actually selling that much eggs in a day. So if your customer demands are increasing, then it's advisable that you access finance either by taking a loan or looking for a business which can give you perhaps eggs, and you pay back immediately. You sell, or you pay back every few days or so. When you have new projects or you're looking to expand either into new territories, new locations, have new business lines, then you might also want to consider seeking business finance. When you take loans, for instance, When you take loans, they usually have tax benefits. Now, when the tax man is calculating your taxes for the year, if you have taken a loan, the interest on that loan is usually taken out before calculating your taxable profits. So when you take loans for your businesses, they usually have a tax benefit. They can lower the taxes that you actually pay as a business. Debt refinancing. If you currently have a loan that requires you to pay, say, an interest rate of 30% per annum, and another financial institution comes to you and says, oh, we can give you a loan for, say, 15% per annum, what would you do? You most likely find a way to go for the loan that has a lower interest rate, just so that you can have savings on your interest expenses and finance costs. There are changes in regulation. For instance, maybe the industry you operate in says, oh, share capital has been increased from, say, $1 million to $10 million, and you don't have $10 million. What do? It means you need to raise capital, or you need to seek business finance. One way of doing that would be to sell shares, which is equity stake in your business, to be able to raise more capital, just for you to be able to remain in business. These are the various reasons why various points for their organizations or for their businesses. Thank you. Thank you. I think we've come to the end of this presentation. If you have any questions, you may send them. You may perhaps unmute and ask the questions, or type them in the chat box so we can respond to them quickly. Thank you.
Thank you, Mimi Nongo, head of ICBC Abuja, industrialists, advocates of for women in entrepreneurs. Thank you very much for having dedicated time, having dedicated resources to bring this very thoughtful and insightful delivery to us at ICBC Global, as we believe ICBC Namibia, Gambia, and the Canada, and all other areas of ICBC in the world are here on this platform. We really do appreciate your time. We thank you for your contribution. Most especially, we want to thank these participants that are here. The floor is open to questions. Please ask questions. I have a long list of questions from this point of moderating, but it is all about our participants. I want to encourage you to please send in your questions. The floor is open. Thank you. So
Okay,
there's a chat.
Yeah. So I have a question from my head of learning. He says, if you have not taken a 100,000 naira loan and repay to build your credit score, the day I need 100 million loan, I might not get. Are you saying loan is an asset? So I would say yes or no. Now, I don't know if this would come as a surprise to anyone, but there's almost no business that doesn't operate on loan or on financing. Even Dangote, who is so wealthy, takes loans. His organization they probably take products from other businesses or other organizations on credit as well. So I would say yes, taking a loan can seemingly be an asset for a business, because it helps to build your reputation, helps to build goodwill, and helps to build a credit score. So I can refer to that credit score as an asset. And we all know, even as individuals, if your friend comes to you today and asks you for urgent 10K, and you give the urgent 10K to them, and they repay that 10K in, say, a month as promised, how would you classify that person? You'd classify that person as someone who has integrity. Now, that integrity is the credibility we're talking about, and that's where the reputation, which is an asset, comes in. I hope with this I have answered your question.
Thank you, Madam Nongo. There's another question on the chat. Participants,
Okay.
please send in your questions.
What is the most feasible sources of funding for the Nigerian SME from my financial experience? So there are many sources of financing. I'll use myself as an example. I started my business while I still had a 9 to 5, and that acted as a great source of income for my business because I was able to invest part of my income into the business and then gradually grew it. I also took advantage of the opportunity that I had access to loans, which were at low interest because my salary acted as a collateral at that point. So I was able to access loans and I put those loans into my business and used them to grow my business. I was also able to access funds from family, from friends to be able to grow my business over time. So I would say if you have a 9 to 5, for instance, and the interest rates are good and you'd want to start a business on the side, that can be one feasible way of getting funding for your business. I also mentioned free trainings, which I classify as a source of finance for businesses. Free trainings, which we also have high rates and short repayment